Okay, so thank you for including our paper in the program. It's an honor to present here. I'm Jinyuan, and this paper is co-authored with Erica and also Gloria's. Both of them are in the conference room right now. Okay, so we started this project by thinking about how technology shaped bank competitions. So I think the common view in everybody's mind, essentially like technology is going to increase competition by inviting new entrants to the market, reduce prices, and hence democratize access to financial services. And indeed, this is what FDIC survey tells us, that they find that unbanked rate has been declining over the past decades. However, at the same time, when you read the newspapers, you also see lots of complaints from out individuals about branch closures in different places. And they're worried that this branch closure is going to impact their access to money in the banks. And this essentially echoes the ongoing discussion regarding digital divide, that not everyone have equal access to digital services, either due to lack of devices or lack of capability to use digital services. And hence, we can see that in the data, adoption of mobile banking is actually quite low. Is quite low for the old individuals, but quite high for the young consumers. And this fact of digital divide inspires to really think carefully what exactly technology do to shape bank competition under the digital divide. And also want to understand what is the distributional effects across heterogeneous consumers in the market. So let me start with a very simple illustration to tell you our intuition. So essentially, before these disruptions, everybody rely on branches to access banking services. Well, we know that operating branch is costly, so we see limited numbers of banks operating in each area. So what digital disruption does is that it allows banks to serve remote customers without the need of branches. Given these situations, then the banks who with a better digital services is going to expand their customers' geographic coverage of customers and hence enter more new markets. If this happens, this is going to naturally increase the local competition, and this is basically in line with the traditional view about how technology reshape bank competition. However, remember that not everyone have access to this digital services, this is the concept of digital divide. And essentially, this benefit of digital disruption is mostly enjoyed by the tech-savvy consumers in the market, for example, young people. In contrast, so the old customers can even, the tech-unsavvy customers, let me say it that way, can even suffer when the banks start to respond to the competitive environment. So what exactly can happen? So as we can kind of see that the tech-savvy consumers already shift towards the digital services, and this happens meaning that their branches become less appealing on average. Due to this, it's naturally that for some banks to close branches in the market. But those tech-unsavvy customers, they are very captive to branch services. If this happens, they can realize there's a fewer number of the banks with branches serving each tech-unsavvy consumers, and those banks can explore their market powers because those customers are very captive to the branch services. And this can induce them to even charge high prices over those tech-unsavvy consumers, sorry. So essentially what happens is that the tech-savvy consumers benefit at the cost of tech-unsavvy consumers who face high prices, face a closure of the banks, and eventually we're going to show that they're going to also face a high risk of excluded from the financial market. So essentially our paper is going to show the important evidence for this whole transformation. And the key message we wish take away after this talk is that technology essentially is going to lead to a segmented banking market, which means that, the branching banks, banks who have a lot of branches, they are going to target only the tech-unsavvy consumers. Vice versa, the branches who less rely on branches, the banks less rely on the branches, they are going to only target tech-savvy consumers. And at the same time, we're going to see that those branching banks are going to become more concentrated. Vice versa, the digital market is going to become more competitive. And these have great implications for distribution effects among these two types of consumers. And we're going to show that tech-unsavvy consumers is going to become more unbanked. Well, they have like less bank account in the market. Vice versa, the tech-savvy consumers is going to become more banked in the market. In the end, we also provide a structural model to try to connect both the deposit market and lending market through branches and to try to address some questions. For example, what exactly digital disruption does? Is that increases the preference of like people's preference about the quality, digital services quality, or is reduce the cost of like operating services to provide lending or deposits. Okay, so let's just directly get to the reduced form analysis. So what we do in this paper is to approximate the digital disruption using the expansion of 3G networks. So why we're doing that is because the 3G networks provide the fundamental infrastructure which popularized the use of the mobile banking. And what we show here essentially to convince everyone that indeed this 3G network expansion can promote the usage of mobile banking. We use the data from FDIC survey, which essentially surveyed around 33,000 consumers every another year regarding their bank ownership as well as the primary ways to access banking services. What you can see from this table is that after 3G arrived at town, and essentially like the people are going to rely on less on branches and more on mobile banking and ATMs to access the banking services. Right? You can show that the lack of the branches is kind of an issue here. All right, so what we do here, well, sadly, you cannot see the animation. So essentially, like the animation works, you're going to see time series variations in both cross time and cross counties. Like the blue light is going to light up across the US. So these very rich variations is going to help us to explore using the staggered different method about the impact of 3G expansion on various outcomes. So in the analysis, regression analysis, we add a saturated set of fixed effect. For example, when we doing the bank level analysis, we include the bank state year fixed effect, such that our comparisons is really for one's bank decision in a county with sharp increases in 3G expansion versus those without within the same states. And similarly, when we do the analysis for county level analysis, we also include like state year fixed effect so that we really restrict to compare different counties within the same states. Okay, so let me just start with showing the aggregate county level results. So I'm not going to show the table because the number is boring, so here is the event study graphs. So we take the treatment year as a year where a county experienced more than 50% of increase in 3G expansion. Well, by nature, this kind of events can only happen once for a county. So what we plot here is basically like the time series trend of number of branches covered in this county as well as the branch concentration over the time, benchmarked to 1 year right before the treatment year. As you can see that clearly, well, this is 0. Okay, if you cannot see clearly, as you can see that exactly on the year 0, and we see a sharp drop of number of branches operating in that county, and also increases in the branch concentrations. And also you can see that the effect actually getting stronger and stronger over the time. In contrast, when we actually look at the pre-window, like the 3 years right before the treatment year, and you don't see much of like the differences compared to the negative 1 year. And this confirms that there's no pre-trend in our, hopefully like confirm you that there's no pre-trend in our analysis. In terms of magnitude, our regression table shows that the full 3G coverage leads to 1.4% of branch closure. Well, you may think like this number is kind of small, but we're going to argue it's not, because this number actually account for around 20% of total branch closures during our sample period. So exactly this amount is only due to the expansion of 3G network, and we're going to argue this is quite sizable. But the branch closure doesn't mean that the people are not going to have access to banking services. In fact, when we look at the lending market, and this figure plot the distribution of number of counties covered by each lender. As you can see that the whole distribution actually shifted rightwards from 2009 to 2017. And what it tells us is essentially is that the scope of competition shifted from the local market to relatively national market over the time. And here we're going to show that actually 3G expansion play an important role to supporting this expansion of service across the national. And we do exactly same event studies, but right now we're going to show the results using the number of lenders serving each area as well as the mortgage HHI index. As you can see that, well, clearly that number of lenders increases, competition increases, and hence the mortgage index, HHI index drop. And in terms of magnitude and the total number of lenders serving a county increased by 2.1% in our sample period. Well, so far what I show is that banks close branches and expand to regions without branches. But then if like every bank does exactly the same, like they close the same proportion of branches, reduce their price uniformly, then you're going to imagine that implications for households' distribution effects is going to be very mild. But this is not what we observe in the data. What we observe in the data is actually there's a tremendously heterogeneous responses across different banks depending on their business model. So obviously, like there's some type of banks, they are going to like focus on provide in-person services and also majorly serve their clients, also value in personal interactions. And we call these kind of banks like branch realigned banks. And also there's other type of banks, they're going to like provide the customer, like the services to more general clients, and by providing, for example, like tech, like cutting edge investment products. And for example, if you can think about State Street, which only operates in Boston, but like they actually serve the deposit clients across US. And we call this type of banks as non-branch reliant banks. So empirically, what we do to measure these two type of banks is based on their branch reliant ratio in 2017, which is starting of our sample. So we're going to argue that if like this ratio is high, that means that banks require a large number of branches to serve their clients. So here, what we show in the table is to separately examine how these two type of banks close their branches after the 3G arrived in the area. And the red highlighted number shows that the low branch reliant banks, they actually close more branches in the regions with sharp increase in the 3G network, but we don't see the effect in the high branch reliant banks at all. So these different dynamics in branch closure patterns actually have profound implications on how they are going to price in the market. Clearly that, well, let me just hide the results first. So, okay, never mind. So clearly that for those non-branch reliant banks, they actually expand their geographic coverage, and they're facing more competitions from similar banks, from the banks from similar type. And these are going to increase competition and force these banks to compete on prices and lower on prices. But those non-branch reliant banks, or those branch reliant banks, sorry, so they're not going to willing to compete with these non-branch reliant banks. And in fact, that those branch reliant banks, they also realize their customers are branching captive. So in the sense that discourage those banks actually to don't close any branches and explore their market powers on their tech-unsavvy customers they have. And these are going to basically predict the divergent price effect from these two type of banks. And this is exactly what we found in the data. And this is result in the deposit market. As you can see that for the low branch reliant banks, they actually reduce prices in regions with higher 3G coverage, and the opposite happens for their high branch banks. And we can also show exactly same results in the loan market for various products, including the mortgage, the new auto loans, the used auto loans, and also unsecured credit. And this confirmed that the divergent patterns of different banks in the market. Clearly, this shows that it seems like before there's like pooling equilibriums of banks serving similar type of consumers, but now different banks actually diverge to serve different types of consumers. And these are going to have great implications on the welfare or consumer surplus of these two type of consumers. Here we're trying to provide the subjective evidence on these distribution effects, relying on the unbanked statistics from FDIC survey. So let me first just show you a basic statistics of unbanked ratio. Even in such a developed country like US, actually you see a great amount of unbanked populations. So there's a 6.4% of consumers who totally do not have any bank account. And this amount to more than 7 million household, 7 million populations in the US. And also, you see that there's 26% of underbanked consumers who used non-bank transactions and credit services. And we know that these are going to be more expensive than the bank services. And regarding the characteristics, those unbanked or underbanked consumers, they are going to be relatively younger, but they are going to have a lower income, less educated, and more likely to be minority. So what's the 3G expansion play a role here? So what we show here is among the relatively poor households in the data who with under 30K annual income, we show that among these households, the old ones are going to actually become more underbanked or unbanked and use more non-bank credit after 3G expansion. And we see the exactly opposite for the younger ones. Okay, so I know along the presentations, you may have a question in your mind, come on, this is not exogenous. 3G expansion is not exogenous. You're not gonna run regressions of bank variables on the 3G expansion, right? So we understand that, so we're also trying to provide evidence, using the IV regressions to address this issue to some degree. So what we do is that we follow literature and to instrument the 3G expansion using the lightning strikes in different areas. So we restrict this, to classify different areas within the same state, such that the fundamentals of different counties, regulation, whatever, is kind of similar within the same states. And this plot, this figure plots the high lightning regions in red column and the low lightning regions in the white color. And what is relevant conditions here? So we're going to argue that the frequent lightning strikes is going to increase the maintenance cost to maintain those very tall 3G tower. As a result, this is going to slow down the introduction of 3G networks because the 3G network providers, they're doing the benefit cost analysis for themselves. So also empirically can show that indeed in the high lightning regions, the 3G expansion is relatively slower than the regions without lightnings. And regarding the exclusion constriction, we're going to argue that while the average conditions in different areas will not actually affect the bank decisions, especially their exit decisions and also pricing decisions. We don't find the stories can actually kind of explain this pattern. And also in the papers, we also do a bunch of balance tests and placeable tests to convince that this IV is kind of valid. And repeat all our analysis using exactly the IV regressions and confirmed results still holds in this scenario. Okay, so just assume that I convinced you that the banking sectors change in the way we describe, but there's a lot of questions we cannot answer using the reduced form analysis. For example, what exactly the digital disruption does? Does that increase the consumers' preferences for digital services, or it helps the banks to reduce the cost of the marginal cost to provide services, for example, reducing the information cost as we see in the last paper, or reducing some operating cost. So kind of to address these questions, we're going to build and also estimate the structural models. And importantly, we're going to add a little bit more features to our model. Why exactly? So what you can see in the reduced form is that the banks actually charge different prices, making their pricing decisions in deposit market and the lending markets separately. But in terms of branching decisions, they cannot separately make decisions to build different branches in different markets. So essentially, there's only one branching decision made by the bank. So then we're going to, because of this, we're going to link the deposit market and lending market through their branching decisions. And also, as you can imagine that the demand functions faced by in the deposit market and the lending market is going to be very different as well. So for example, because of life cycle problems, then in the deposit markets, they're naturally to have more depositors, but in the borrowing market, they're naturally to have more borrowers. And also, people may have different branch reliance in different markets, so we're trying to capture all these kind of aspects. So our model is actually just 3 lines. It's not complicated, but it's very flexible enough to capture our stories. So we have a bank competition models with 2 types of consumers and two types of banks. And for each type of consumers, they care about how much they pay, how much branch they can access to, and also what is digital service quality they can have for each type for the bank. There's also C terms which captures the observed characteristics of the bank. And also, we include a nested larger random taste such that the consumers can have correlated taste among the banks within the same type. And in the supply side, we have 2 types of banks, and we're going to let the data to tell us how different they are. But each banks, they're going to decide their rates in deposit and lending market, and also decide how much branch they're going to offer to support both markets. And to close equilibrium, so we're going to allow the endogenous entry and exit so that every bank's on the margin just break even. Okay, so as you can see that there's unobserved bank characteristics, so we need to use instrument when we estimate the demand functions for the consumers. So for the literature, but a little bit more than literature, what we do is that we instrument using the bank's cost shifters, for example, the shifters in where they have branches in. For example, like the cost shifters including the wages, house prices, and rent prices in the regions. But more than literature, what they do is that when we estimate the demand functions for one particular counties, we're going to using the bank's exposure to other regions, cost shift shocks, where they have the branches on, so that we're going to exclude the coverage of the county where we're doing the estimation, so these are going to hopefully reduce the endogenous problems in the estimation. So what I show here is just like selected parameters from our estimation. So from the first 2 rows, what you can see that is that for the old consumers, not surprisingly, old consumers are more inelastic to the price changes in both markets. And also, we can show that in the deposit market, both type of consumers are more inelastic to prices than the lending market. I think this is also kind of intuitive because in the deposit market, maybe we don't really like try to shop rate and across different banks. And also there's a more like relationship bankings there. And for the 3rd and 4th rows, what we show is that also intuitively that old consumers actually rely on the branch services more than their younger consumers. So the coefficient is larger. And the last 2 rows shows the perceived digital qualities by different type of consumers. And interestingly, in the lending market, we actually don't see the differences across 2 types of consumers. And our rationale is that maybe the digital services in the lending market has been growing for a while, so everybody kind of like value the lending services, the digital services in the lending market. But there's like a very there's a difference in the perceived qualities in the deposit market that young people actually cares their digital qualities in the deposit market, but old people doesn't. Okay, so with this estimate demand functions and we also estimate supply side parameters based on equilibrium outcome. And then what we do is that based on these parameters, we're going to calibrate the parameters to match the effect of digital disruption identified through our reduced form analysis. So essentially, like because of a limited number of identification moments we have, so we're going to only focus on two dimensions in this calibration. So we're going to calibrate the changes in digital services perceived by the young consumers, as well as the marginal cost of branch reliant banks, because we think these 2 dimensions are mostly driving, could reproduce these divergent pricing patterns in the data. And our analysis, our estimation calibration numbers tells us that actually like what we observe in the divergent patterns and also branch closures is mostly driven by the change of digital services perceived by young people. As you can see that their estimated coefficient change is much larger. Okay, I cannot come back. Okay, so it's much larger for their perceived qualities than their cost parameters. So we kind of like this provides suggestive evidence that this is what drives people's behaviors to young people's behaviors to move to digital services after digital disruption. Okay, so this figure, what this figure shows is that what is welfare changes in our calibrated models. And I can see that consistent with empirical evidence, we can replicate that the old consumers is going to suffer in both lending market and the deposit market. And let me emphasize that when we calculate this consumer surplus, we already subtract away the changes in household consumers. So what this one really captures is only the surplus changes from the structural changes in the banking sectors, like how they close branches, charge different rate, and also exit entry of the different types of banks. We consider two types of counterfactuals. The first one, we're kind of thinking about whether this effect is driven by digital disruption shocks in the lending market or deposit market. So we kind of like close down the parameter changes in the deposit market in the first in the left side, in the left side graph, and also shut down the lending market, shut down the. We only allow that the digital disruption disrupt the lending market in the right figure. So as you can see that there's a very mild impact on consumer surpluses when the disruption only happens in the digital market. And the reason is that if you still remember that in the deposit market, the consumer pool consists of more old households. And so by the same tokens, in the lending market, when there's a digital disruptions and there's a more young tech-savvy consumers in the market, and this disruption is going to really drive those young customers shift towards digital services and force the banks to close branches. And our story follows that the banks are going to charge high premiums, high markups for tech-savvy consumers, and this hurts their old deposits a lot in the deposit market. And our counterfactual studies, what exactly matters for our story? Is that rate changes or branch changes? So to study these problems, we on purposely close down the branch closure mechanism in the left panel. And in that ones, the banks do not allow to close branches, they only allow to change the rate. And you can see that in these cases, the whole effect is very mild. So this highlights that importance of branch adjustment in our stories, because only if the branch adjusts, then we're going to enter these segmented market scenarios, and these are going to have profound impact on the distribution effects. Okay, inspired by this one, this is the last slide. Inspired this one, so we're going to propose a branching regulations which restrict the percentage branch allowed to be shut down after digital disruption. And clearly, these are going to help improve consumer surpluses, and this is what we show for both depositors and the borrowers. All right, so since I kind of run out of time, I believe, so let me just quickly conclude the paper. So hopefully, right now, I can convince you that the important impact of digital disruption is drive the banking sectors to more segmented, and these are going to have a negative impact on consumers, on old consumers, tech-savvy consumers in the market, which we also care about them. So why this is important? Well, you may ask, like, okay, yeah, some people are going to always be left behind, but what we show in this paper is that it's not their left behind, but like the endogenous changes of supply side, which is banking sectors in our cases, are going to actually exacerbate this negative effect on their tech-savvy consumers. And this is kind of like ignored in the current literature. And we think this framework also can apply to different stories to think about how exactly technologies affect distribution effects across different households. So thank you for your time, and looking forward to the discussion of the James.